I think we've let the waiting room in. Welcome to everyone who's been in the waiting room. And we're going to give it another minute or so for other people to continue to join us. But this is our first installment of the PEMBA, the Physician Executive MBA program lecture series for the Physician Executive Group of the Georgia Association of Healthcare Executives, and that is a lot of acronyms that we could put out, string together there. All right, so I'm going to go ahead and hopefully everyone can see and hear us. I'm going to go ahead and introduce Dr. Behn. And I think most people on the line know me. I'm Boykin Robinson, run Core Clinical Partners in Atlanta. And here, one more in the waiting room. So today we are honored to have Dr. Bruce Behn, the Associate Dean for Graduate and Executive Education at the University of Tennessee Haslam School of Business. He's been there for quite some time and held a number of leadership roles. He was a professor of mine when I completed the program in 2018, and I'm very excited to review some of what I already learned on how to read financial statements. And with that, Bruce, I will. Oh, one thing I think Bruce is going to say this as well, but I wanted to make sure you guys understood that feel free to jump in and interrupt with questions, because it's really hard as you think through it. You'll see as he starts going through financial statements and 10Ks and how to get there and all that. You want to ask your questions in real time so that you can keep up and understand the next thing he's going to get to. With that, Bruce, I'll turn it over to you.
Hey, Boykin, thank you very much for the introduction, and it's great seeing you again. And Bruce, thanks for all the behind the scenes stuff that you're doing. Very much appreciated. Listen,
you're welcome.
This is a two-part series. One is we're going to talk about understanding financial statements, and then part two will actually be trying to compare two companies using ratios, etc., and to determine the health of the company. As Boykin knows, in particular, this is somewhat difficult to do in 1 hour. He had me for a few sessions when he was in PEMBA. Basically what I'm going to do, everybody, and if you want to follow along, if you have a computer and you just want to follow along with me, feel free to do that. And Boykin mentioned earlier, please ask questions as we go through this. And that includes Kate and Tom if they want to ask questions too. And so what I'm going to do is what I usually do is I'm going to download a healthcare example. So we're actually going to look at HCA today's financial statements. So let me share my screen and we'll get going here. All right, can someone give me a thumbs up that you see a Google page that, okay, fantastic, thank you. And again, so what I'm going to do here is notice I put into the Google line here, HCA investors. Now, why am I doing that? Because I want to find some of the current financial statements for HCA, and this is kind of a quick way to do that. So I'm going to click on this, and you notice what comes up right away is, and by the way, I just want to make sure this is changing with me. Does it HCA investors? Okay, cool. Thanks, Boykin. So notice there's a bunch of information here under investor relations, and one of those is called financials, right? And if I scroll down, the ones I really want to look at, you can look at annual reports, but I'm going to look at SEC filings. And by the way, that is not the Southeastern Conference filings. That is the Securities and Exchange Commission. They are two different entities and somewhat get confused sometimes. But anyway, so SEC filings, and notice there's a lot of filings here, and I don't want all the forms. What I want is to look at annual filings. So if I click on annual filings, there's something here called a 10K. This is an annual requirement from the Securities and Exchange Commission. And I'll show you what that looks like in a minute. But notice on the left here, this is for year ended, and I'll show you the actual 10K in a minute. But it's for the year ended December of 2020, December 31st, but it was filed, if you notice on the left here, on February 19th. So the good news is that they actually filed this on time, which is appropriate. And I'm going to click on this 10K, but what I'm going to do is click on the PDF version so I can scroll through it easily. Notice there's Excel, there's document, and there's a lot of different ways you can download this. But I'm gonna click on, and by the way, is there anybody following along? If I get going too fast here, if you're following along, just stop me too, okay? So I'm gonna click on the PDF version, and notice the 10K for HCA comes up, and a couple things to notice. It says, for the fiscal year ended December 31st, 2020. Again, this is the most current annual filing we have. The company also has to file quarterly information with the Securities and Exchange Commission, and those are called 10Qs. But this is the last annual information that was filed. So notice it's a fiscal year. By the way, some companies, if they're doing fiscal years, can have fiscal years at the end of September, end of June. It varies kind of by company, but here again, it's at the end of December. I'm scrolling down, and again, can you see kind of a structure that says part one? And somebody give me a thumbs. Okay, thanks, Morgan. So notice every company, a publicly traded company, will have the same structure here. You know, part one, part two, part three, and part four will be there for every company that you look at that's publicly traded. The information that's in these items can be different because most of this is written by the company themselves, right? So notice in part one, excuse me, they talk about business, risk factors, properties, which everybody can look at. Part two has, the big thing here from my perspective is a couple things. Notice item 7 is called management's discussion and analysis of the financial condition. Again, you have to take that, you have to look at that kind of with your radar up a little bit, because this is management's way of telling you what's happened during the year. And of course, they're going to try to spin that in a positive light. But again, this is filed with the Securities and Exchange Commission, so they can't say something outlandish, right? Because otherwise they'll get into trouble. Notice item number 6, though, it says selected data. I'm just going to click on that, item 6. And if you notice this, right above this is a graph of their stock performance. Everybody who files a 10K has this. And if you notice, again, they compare in this one, HCA, which has the box, little box around it, if you can see that. And then they compare themselves to the S&P 500 and then to the S&P healthcare group. And again, companies here can pick their peer comparisons. And so, you know, if you look at Coca-Cola's, for example, they'll have a completely different set of peer groups, obviously, that they're looking at. But again, it's positive news here. HCA has done very well, right? If you look at the graph here, compared to the S&P 500 and the S&P healthcare market indices, they're doing pretty good. And so you would expect probably, if I'm just looking at this, I would expect the financials to look pretty good, especially for 2020, given what's happened here with the stock price. Another thing is, I'm sorry I'm laughing, but this is kind of funny as an accountant, because, you know, if they say selected financial information, the company can put in whatever they want here. And if you go to different companies, you're going to see different things included here. This is the first time I've ever seen a company that put none, which is kind of interesting to me. So HCA has nothing to show or highlight that they think is worth showing you in their management and discussion and analysis, which is kind of interesting to me. So what this is about, though, is I'm going to go back to the main screen, because what we really want to talk about is the financial statements and supplemental data. So what I'm going to do here is scroll down and get to the actual financial statements. And notice there's a lot of stuff in here, right? Before I get to the financial statements, so I want to, this is actually, as you can guess, these big companies are audited by a public accounting firm. In this case, it's signed down here, I think, by Ernst & Young, right? Yeah, Ernst & Young. They have served as the company's auditor since 1994. But I want to read you one line in this audit report to make everybody aware of this, right? So if you look at the first paragraph, the last sentence is really important. It says, in our opinion, the consolidated financial statements present fairly in all material respects the financial position of the company at December 31st, 2020 and 2019. Now, I'm going to ask you a little later on, and Boykin, heads up, I'm going to ask you a question, right? Is what does that mean to you? Or you'll end up, if you want to answer this too down the road when the question comes up, these financial statements present fairly in all material respects. That's a key item of an audit report that everybody has to understand. Because when we get to the financial statements, one of the things that's always interesting to me, so this is the income statement for HCA, and it gives 3 years, right? The point I'm going to try to make up front here is that most of us who have bank accounts, right, we balance checkbooks, etc. Everything's balanced out to probably to the cent. You got to understand that these financial statements, so this is an income statement, and I'm going to tell you right now that every number on this income statement is an estimate, right? Every number on this income statement is an estimate, according to generally accepted accounting principles. So it isn't like a checkbook. These are estimated numbers, and you notice that it's not going to be down to the penny, because if you look at the year 2020, the revenues for HCA, it says it's 51,533. Well, what is that? Is that 51 billion? Because it's in millions, right? If you look at that, so it's in millions, and they round off to the nearest million. Now, how many of you would love to have that rounding off, right? Wouldn't that be cool? Yeah, there you go. Yeah, I agree. I mean, so I'm going to kind of tell you the good and bad and ugly about financial statements, but again, these are not down to the penny. They're estimates. They get rounded. But again, it comes back, you guys, to this concept of materiality. All right, so I'm going to spend a little bit of time so we understand that. So if you take the bottom line net income, right, that's what, $3 billion, I guess. Boykin, is that right? Would you say that's $3 billion? 3,754,000? Yep. Okay.
Just like my checkbook.
Yeah, that's your incentive plan right there, your option, right? So if you look at this, everybody, what if that number is not 3,754,000, but really should be 3 billion even? What would you say about that? Is that a problem? Right?
Then all of a sudden you have 3 years in a row of decreasing net income.
Yeah, and the big point here to me is it's off $700 million. So is that a problem with people? Well, this gets back to materiality. To a lot of people, being off $700 million here would be a problem, right? But again, this gets back to the materiality concept. What if that number, instead of 3,754,000,000, should be 3,751,000,000? I don't think people would be upset with that, would they? Because it's only off like, what, 3 million or whatever it is. So that's probably not a problem. So the point I'm trying to make here is these financial statements are based on estimates, they're rounded, and there's a materiality threshold that's built into here, you guys. Because the auditors, and I've asked a lot of CFOs this question, under generally accepted accounting principles, how much can you move net income or earnings per share, right? And every one of them said from 3 to 5% without even hesitating. So there's some wiggle room here, you guys, that's in here is what I'm just trying to tell you. The other thing that's really important is, notice this income statement is for 3 years. And at the bottom down here, and this is a really important item, and I'm not going to get into the why this is, because notice it says net income, and then it says net income attributable to non-controlling interest. Okay, you don't have to really understand what that is, but basically what happens here is HCA has a partial investment in other companies. They're called equity investments. And so there's some other shareholders that own a portion of these equity investments. And so when you're doing, and this gets into, we're going to do ratios later on in the next version of this, but if you're looking at, and Boykin, you have your own company, right? If you're looking at earnings per share, you want to look at net income attributable to HCA shareholders, right? Not the non-controlling interest shareholders. So that's why the bottom line there is so important, because that number 3754, the 3,754,000,000, is divided by weighted average shares outstanding to come up with that. You see that number there, basic earnings per share of 1110, right? So that's taking the net income attributable to HCA and dividing it by the weighted average shares outstanding for HCA itself. So let me just stop there for a second. Are there any questions about the income statement?
Can you say that one more time? So you said you took the net income at 3,754,000,000 and you divided it by what to get the basic earnings per share of 11
Yep.
million? Was that $11.10 or 11?
Oh, Yolanda, is it Yolanda?
Yes.
Yeah, my trifocals are trying to zoom in here. Yolanda, that's a great question. So normally companies will give you the weighted average shares outstanding. HCA didn't, it's not required. But for example, if I take 3,754, that number, that net income number, and I divide it by 1110, okay? That tells me there's 338 million shares, weighted average shares outstanding in the company. And I can check that later on. It'll be in the notes, but I'm just telling you that's what it is. Normally the companies would specify that right below here, but they didn't do that this time. But to me, listen, I've been doing this a lot of years. Earnings per share is really important because you can compare that across companies because it's scaled by the shares outstanding of the company, right? And also, and I'll show you in a minute, when I do ratio analysis, one of the things I always look at is the pure fundamentals of the company. One of those is earnings per share. Another one is taking operating cash flows from the cash flow statement, which I'll show you in a minute, and divide that by that same weighted average shares outstanding and compare earnings per share in that one, because those are the two basic fundamentals of any firm. And we'll come back to that. But
hey, Bruce, there was a question in the chat. Can you explain weighted average shares outstanding?
yeah, so let me, I'll bounce around here a little bit. I'm going to go to the balance sheet. Okay, so if you look at this, notice on the balance sheet at the bottom down here, see where it says stockholders equity section? Okay. So notice I'm highlighting this a little bit. It said the outstanding shares for HCA at the end of the year was 339 million. Does everybody see that? Can you give me a thumbs up? Okay. That number is the weighted average shares at the end of, excuse me, that number is the actual number of shares at the end of the year that are outstanding for HCA. The weighted average shares outstanding is usually done by taking that number every month during the year and then averaging it. That's why I came up with 338 million versus what they had at the end of the year of 339 million. Did that make sense? Did I answer the person in the chat? Can you?
So weighted is essentially just the average.
Yep.
Over 12-month period of time, or whatever the time period is. Okay.
Well, it's, Yolanda, it's always a year.
Okay.
Okay, that year that they're measuring, but it can be measured quarterly. Some people do it monthly, but it's usually done monthly.
Okay.
So they'll take the actual number of shares outstanding every month and then average that over the year.
Okay.
And shares outstanding is essentially the number of shares that the company has sold?
Yeah. How do you, is it Marzina?
Yes.
Marzina, that's another great question. Okay. So,
sorry, I know this is very basic.
No. It is not basic. It is a great question. Okay. HCA, I'm going to tell you. So they noticed when HCA incorporated, and I can't remember the state, it's probably Delaware that they incorporated in. But when they did that, they are authorized by the state and by the board to issue a certain number of shares. So you're going to notice here that the authorized shares are 1.8 billion. Do you see that number, Marzina?
No, I don't see it. Where is it?
Okay, let me highlight it.
Here. Okay, got it. Yeah, thank you.
Okay, so that is the maximum number of shares that HCA can issue without going back to the board and the state to increase that number. Okay, that's the maximum. So to date, I don't have the other numbers here. It looks to me that they've issued outstanding shares. So usually what happens here is that they issue shares like in an IPO, right? And then they can issue shares throughout the year. Now, some firms, and we can look at HCA in more detail in a little bit, but some firms can actually buy back shares, and those are called treasury shares. So if I look at this, this is another schedule that may make a little bit more sense here for you, right? So you notice what they've done over time is they've issued shares and then they've bought back some shares, right? So over time, then the ending number here of, look at the bottom down here, This is the number, this is a really important number. So that number is the number of shares at the current time that are outstanding in investors' hands. So Marzina, that's like you, if you owned, 10,000 shares of HCA stock, right? You would be part of that 339 million shares that are outstanding now. And why is that important? Because that number is used to calculate the weighted average shares outstanding, and that number is the number that's used to base what they pay dividends on, right? So only people withholding these outstanding shares are the ones that can get paid dividends, and they're the only ones that can vote. So if they hold shares in Treasury, the Treasury shares can't vote and they can't get dividends. Marzina, I know that was a long-winded answer, but did that get at what your question was?
Yes, that was excellent. Thank you so much. I guess a more basic question, if I could follow up real quick, is why is it important to know how many shares are outstanding for a certain company besides what you just mentioned about the dividends?
Yeah, so for me, again, Marzina, there's a couple of things, right? It's used to calculate earnings per share. So net income divided by the weighted average shares outstanding is a very important number, because that's the number that's given to the street, right? That's the number that we can use to compare other companies. That's a number that's used to have a ratio, which we'll talk about next time, which is a price earnings ratio. And besides that, again, anybody that owns a share at the end of the year of that 339 million, they are allowed to vote, right, on matters. They're a voting member, and they also are allowed to get dividends. They're the only ones that can actually get dividends. So Marzina, those are the big reasons for me. Does that make sense?
Yes, thank you. That's perfect.
So let me go back. You guys just keep asking questions. That's just awesome. So again, if you look at
Hey, Bruce, sorry. Just real quick, the diluted earnings per share, is that just like profits, interest, and phantom equity and other things like that? Or is there something else that comes into it?
Now, Boykin, you should know me better than that. We have no phantom anythings around here, right? So what Boykin's saying is, I worked for Allen Bradley, which was a privately held firm, and we actually had Morgan Stanley come in and create a phantom earnings per share incentive plan. So that is that. But what this really is here is basic earnings per share, again, is net income divided by the weighted average shares outstanding. What the diluted number is say you have convertible debt, for example. So you have bonds that you have that can be converted into stock, right? Or you have warrants, or you have options that can be converted to stock. So what the accountants do is they take all that stuff, and that's a technical term, right? Stuff. They take all those things and they do a calculation as if all that stuff got converted to stock, and then do a measure of earnings per share. So that's some of would call it fully diluted earnings per share, but that's the diluted earnings per share.
But it's only the more real stuff, like what you mentioned, not profits, interest, and phantom equity.
Yeah, it's all the real stuff.
It's the real stuff. It's the convertible notes and stuff. Okay.
Yep.
So I had a quick question about that real quick. So with the diluted, then, from what you were saying, turning that, what kind of debt did you call it?
Yeah, so Yolanda,
that debt so it looks like it would make your earnings less. I thought you would grow more. So if I turn in my bonds, I would get more money, but it seems like because the number goes down.
Yolanda, you asked another fantastic question. I really mean that. So first thing is, there's a difference between cash and income statement, which is generally accepted accounting principles. So this income statement is under what we call an accrual basis. And then we have a cash flow statement. Okay, so those are two different things. I won't get into any further than that, but take your question of the convertible bonds. Okay, so and I'm using this as an example. So say I have I issue to the public, $500 million of convertible bonds, right? And each of those can have their own specifications. But in this case, they can be converted down the road, but they are convertible into common stock. So what the accountants come in and go, okay, since you have this on your books as convertible debt, we are actually going to make that conversion and then put that into this new calculation. And what that does, Yolanda, is it increases the denominator, which is the weighted average shares outstanding. And that's why you see that number go down, because the denominator gets bigger. The net income number stays the same though. Yolanda, that's a great question again. Yep.
And when you're using your, this will be next time, but when you're doing your ratios, do you use the earnings per share or the fully diluted earnings per share?
I always use, well, in my fundamental approach, it's the basic earnings per share, but it's the big number I use, Boykin, is that net income attributable to HCA shareholders.
Okay.
Yep. Great questions. So in a nutshell here is, this is partially a COVID year too, right, you guys? Is HCA doing better across time? Yeah. And that leads again to that one market data thing we looked at too, right? All right, so one last thing. The income statement measures activity across time, right? The time can be a year, it can be a quarter, it can be a month. But notice the income statement here, in this case, it's measuring a year, and it's given me 3 years of data to look at, which is kind of cool, right? But again, this measures activity across a period of time. So let's scroll down. Now this stuff, this is where people blow their minds over. I'm not going to spend a lot of time on this, but but just so you know, there is a lot of lobbying going on in the accounting world, and basically what gets included in comprehensive income that's not in net income. The banks the commercial banks back in the day hated volatility. So if there's any item that has a lot of volatility in it that's caused by market changes, now they say, we don't want this on our income statement. We want this in a special category called comprehensive income. So this doesn't hit the income statement. It actually, you'll see it goes through the balance sheet, but the real meaning behind this is companies didn't want volatility caused by external areas, market forces, et cetera, to affect their bottom line P&L net income. And so that's like pension plans, unrealized foreign currency trans. You don't need to know what that is, but that's just what that stuff represents. Okay, now we get to the second item here, which is called a balance sheet. You notice a balance sheet here is items, this measures what occurs as of December 31st, 2020 and 2019. If you think about your own personal balance sheet, you guys could put one together, right? You could put all that big cash you have in the bank, all the, nobody has any loans or anything, right? You subtract your assets from your loans and you have this huge, big equity in your personal life. Well, think of it that way. It's a measurement, a picture of your situation at the current time, you guys. So let's just look at the assets here to start off with. every balance sheet is set up kind of the same way, okay? The first thing I will tell you, there's only 2 items on this balance sheet that are not estimates. And most people kind of freak out about that, but it's true. There's only 2 items on this entire balance sheet that are not estimates. One is cash, and the other one is the actual shares outstanding of stock. Everything else here is an estimate again. And also, if you look at this balance sheet, let's look at the assets. Every balance sheet is structured the same way. So it's structured from a current asset to a longer term asset, right? So if you look at cash, you know, that's kind of a current asset, right? You can cash, you can get out pretty quickly, right? Receivables, if I wanted to turn those to cash, I could probably do that pretty quickly too, right? I could, if I wanted to, I could actually sell off my receivables. And as you move down the list, things become more long-term in nature. So next is property, plant, and equipment, right? I think all of us can see what's there. And if you, well, let me stop there in a minute. And well, let me go. So property, plant, and equipment, I'll come back to that. And if you scroll down, then you have investments and other things that are much more long-term in nature. So and another way to look at this is it goes from stuff that's really concrete like cash, right? I mean, we know what cash is, to something called goodwill, which people go, what is that? Which I'll talk about in a second. So I'm just going to talk about a couple of these because they're probably of interest to you. So notice property, plant, and equipment, it says stated at cost, right? And there's a reason for that. So if I look at land, that doesn't change too much across time. But land is everything that's in land is a cumulative number that represents what HCA has paid for land, okay, across time. So it's a picture right now. So they own $2.2 billion of land, but remember, it's at original cost, all right? And this is something that accounting statements, people really get wound up about, right? If you had your own personal balance sheet, right, and you were going to show your house on your balance sheet, I would bet every one of you would put the market value of your house on the balance sheet, right? Especially if you're going to go get a loan because you want a bigger loan, right? For accounting purposes, most things, there are some things that are market, but most things are at original cost. So if you look at this number here, this 2.2 billion, that again is all the land that HCA has purchased across its entire history that it still has in its use. And that is not the market value of that land. So you and I can both guess at what the potential value of that land is for HCA, right? And Boykin was telling me they sold off a bunch of properties recently in Atlanta, right? They probably made a bundle on again, the land value of what they sold, right? And that goes true, you guys, for the buildings too. So the buildings, this number right here, this 18,471,000,000 is actually everything that they purchased over time that they have still in use today. That's the original cost of the items they purchased. So that over time, again, they still have in use $18,471,000,000 of buildings that are out there. Yolanda?
Yes, okay, thank you. I have a question. So what you're saying is that they would go with the original because they want it, is it because they want the number to be as low as possible?
No, because Yolanda, you are asking some really good questions. I mean that. So Yolanda, here's the issue. It's an accounting problem. And Kate knows we have a lot of accounting problems. So here's the reason, okay, Yolanda, why that has to be at cost. It's a generally accepted accounting principle. And the reason the accountants don't let you put in market value there is, for example, you know, you could get the Behn brothers to come in every year and appraise property values that would be all over the board every year for a company, right? You know, I'll give you the right appraisal that you're looking for, kind of thing. It fluctuates so much because these assets, most of these assets are like one-off assets, right? That there's not a market for a building, you know, in downtown Atlanta. It's a one-off thing, right? So it's an accounting kind of rule guideline that says it's got to be at cost. Yolanda, does that make sense? Great. Okay, now, land is not depreciated ever. That number just stays the same. But buildings, equipment, etc., can be depreciated across time. Again, when they're depreciated, right, and the asset's still in use, right, that number there, that accumulated depreciation number, is basically all the depreciation for those assets, excluding land, that are currently in use. So that's the total depreciation across time related to those assets above. It's in a bucket called accumulated depreciation. Now, the one thing I will say about this and point out an example, say in there, I have a building that's worth $50 million. So in that building number, that 18,471, I have a building that cost $50 million, but it's fully depreciated, but it's still in use. So the way the accountants, the way that would show here is that in that 18,471,000,000, you would have 50 million related to that building at cost. And then in the accumulated depreciation in this 26,118,000,000, you would also have 50 million of accumulated depreciation related to that building in this number. So that what we call it in accounting, the net book value of that asset would be 0. But since it's still in use but it's fully depreciated, that's the way that would show. Does that make sense? Clear as mud out there? All right.
Hey, Bruce, when we look at next year's HCA balance sheet, and we know they sold 4 hospitals in Georgia, do they have to recapture that depreciation? Does that come up somewhere?
Yeah, so Boykin, another great question, right? So let's just use that as an example, that fully depreciated building of 50 million, right? As an example of one of those places, right? So what would happen then is, say they sold it for $75 million, which could be a price, right? So they'd get cash of 75 million, right? They'd have to bring down the cost of the asset of 50 million. They would have to get rid of the accumulated depreciation of 50 million. And then they would have a gain of $75 million they would have to put on their books, Boykin, right?
Okay.
Does that make sense?
Yeah, that makes sense.
Great questions. Keep them coming. Anybody else? All right. I'm just going to jump to another one here. Notice goodwill. Everybody always asks me about goodwill, right? So basically, everybody, what goodwill is say HCA, they're going to go out and purchase a hospital group for $100 million. Okay. And the accountants come in and everybody has appraisals of the properties and their patient list, and everybody comes up with a value. So they come up with a net market value minus the liabilities, right? And say that was $80 million. So, right, they mark to market, we always call that in accounting terms, mark to market. So they mark up all the assets, they mark up all the liabilities to what they really are. And then that net value, let's just say that that's $80 million, right? But because of strategic reasons, they're actually going to buy that hospital group for 100 million, right? So the accountants can actually go in and mark up the assets where they go on the balance sheet. They can mark up the liabilities, but there's 20 million they don't know where to put, right? And so what the accountants call that then is goodwill. So basically it's what the cash that was paid to buy the entity or entities, which is greater than the net market value of the company. All right, does that make sense? Yolanda?
I assume there's a ton of wiggle room there.
Well, yeah, the wiggle room is, I mean, again, listen, I was part of the due diligence team for Allen Bradley back in the day. And we would come up with what we thought the right market value was, you know, of the assets minus the liabilities. And then it was a negotiation with the CEO and the group of how much, you know, a lot of this boils down to egos sometimes too, about what they want to pay because they want the assets, right? So I don't know if I'd call it wiggle room, but it's again, that is a negotiated price that people pay for things, which is above, it usually is always above the net book value or the next net market value of the asset. So like it makes sense?
Yeah.
Yolanda, you had a question in there. I know you did.
I might just have to read up on that one on my own, but I didn't follow the goodwill. It just seemed kind of like a sleight of hand kind of stuff, but maybe I just need to kind of marinate in it.
Yolanda, are you saying the accountants have sleight of hands here?
I mean, it just seems kind of.
I'm with you, Yolanda.
A lot
agree.
of fast talk, and I was like, okay,
okay.
I'm not processing.
Yolanda, let's put this in your terms, okay? Say you want to go out and buy a used Mercedes, okay? What value are you going to put on that Mercedes? Where can you look for, you know, Kelly Blue Book or
The Blue Book, right? I look in the Blue Book, yes.
All right, and what else are you going to look to determine for that market value of that? And it's a very nice Mercedes. It's a unique one. It's a, you know, where are you going to get the market value for that thing?
Well, I'll look at the Blue Book, and then I'll look at some of the amenities that it has, and then I'll compare it to some of the other models that don't have the same amenities, and then I'll kind of see what the prices are at different dealerships for that same car with the same amenities.
All right, Yolanda. So what if you do a little work here, and you have 15 dealerships with the same car, and you average all those market prices that are listed on the car as the market price. All right.
Okay.
You with me?
Uh-huh.
Now, if you bought that, now you're gonna buy the car, but this dealership, they want a higher price. So they, instead of, you know, 20,000 for the car, they want 26,000.
Okay.
And you really like this. It's a little newer, less mileage, nice color. Plus you just want that car, right?
Okay. Okay.
And you're willing to pay 26.
Okay.
The accountants here, if you think about this, they would say 20,000 is the real value of the car.
Mhm.
And then you paid the extra 6 for something else, Yolanda.
Okay.
Right? And that's something else in a corporate world is called goodwill.
Okay. Okay.
Okay. Does that make sense?
I got it. Yeah.
Yeah.
Mhm.
It's for other things that the accountants can't quantify.
Okay.
Right?
Okay. Thank you. I get it now.
Again, great questions. All right. We have a little time left here. So there's one point I want to, we're going to go on to the current liabilities. And there's one thing here I do want to tell everybody, because I know it's a little nuance in accounting, but it's a kind of a big deal. So if you look at accounts payable, right, in every company, what that represents is the company has received an actual invoice. So they have an invoice from a vendor that's in the system, which is usually called the general ledger. And so that's the cumulative amount of invoices that they still haven't paid. Does that make sense? All right. The next item is a pure accounting item. Okay, and this is important because these financial statements are based on accrual GAAP accounting. So this is called like accrued salaries and accrued expenses. So let's take accrued salaries. I mean, that's 1.7 billion, right? So what that represents is at the end of the year, right? Let's just say some people are paid monthly, right? And so they get to December 31st, but the actual cash doesn't come into their bank statements until January 6th. All right. So those accrued salaries are items that's a liability because they do owe it. You guys have earned that money, but the cash hasn't paid out yet. So it's a liability. Does that make sense? And there's other things called other accrued liabilities. See right below that? And that is $3.2 billion. And one curiosity, the curiosity that you may have is, what would be in $3.2 billion of other accrued? By the way, my favorite category, I used to be a controller, and my favorite category out there, you guys, is other. Whatever I can put in other is just great, right? You don't have to detail it out. You can just put it in other. So notice they have other accrued expenses. So if I scroll down, by the way, if I wanted more information, and we didn't get a lot of time to talk about this, but if I wanted more information, where would I go here? I would go to the footnotes. I know you guys didn't even know footnotes existed, but I'm just going to go here quickly and see if I can find something. Where is this? Okay, normally if you look at this stuff, you'd have details of what's in accruals. And I'm scrolling down to find it. Switched it on me a little bit here. So there is long-term debt. All right, I can't find it, but anyway, normally you'd actually get to see the details of what was in the accruals, which would be very nice. And usually they have that in a footnote, but I'll come back to that a little later, maybe next time, if I can see where they put it. All right, so notice this next thing was long-term debt. Notice long-term debt is a big number. They have $30 billion in long-term debt. And notice it's gone down over the years, so maybe they've actually paid some off. So, but if I wanted to know some more information about what was in long-term debt, let me scroll here, and there is a footnote, which I saw here earlier, that has long-term debt. So notice all these notes are describing what is. So here's the note on long-term debt. So notice it ties out to the $30 billion that's on the balance sheet, you guys. And if you notice what's in here, you'll look at, there's a lot of different debt that they have at different rates. Some of it's secured, some of it's non-secured. Notice it gives the actual rate that they get it at. But if you notice, most of these rates are fairly low, right? So it's 5.1%, 2.8%. But again, given the low rates, it's a very cheap way of getting capital for the organization, right? And you'll tell here in the notes that they've actually issued 2.7 billion. They'll tell you what they did during the year. So these footnotes are useful to describe if you're looking at changes from year to year about what actually they did. So are there any questions on that? Yolanda, no questions? So notice these footnotes, actually, they give you a little bit, like note 5 tells you about earnings per share. If you want to get some more detail, and this gets back to Yolanda, your question a little earlier. It describes what's in there. And anyway, let me go back to the. All right, the last thing, well, we don't have much time, but we can notice in stockholders' equity here, there's a bunch of things. One of the things that is really important from an accounting standpoint is looking at retained earnings. People always wonder what's in retained earnings. The cumulative number of retained earnings, everybody, is the cumulative amount of income and loss of the company. So this retained earnings down here of 777, that means it's the cumulative amount of earnings or loss the company has had since its inception, less any dividends that are paid to stockholders. So you notice in here, there's some other little things, but don't worry about that. But retained earnings across time, again, is you can do one or two things with retained earning, with a share of earnings, right? I can reinvest it back in the company, or I can pay it out in dividends. Well, I can do one of two of those two things. So this represents, again, and by the way, if you look at this, this is one of the first times in a long time that retained earnings is actually positive for HCA, which is, again, another good sign. And that's, again, being shown in kind of the market data we saw earlier. I think we're probably a little out of time here. Any other final questions? We got like a minute left. Yolanda, I know you got one more question in you.
Oh, you've done a good job. Thank you. I appreciate it. These are things that I know I need to know and probably do some background reading on, but this has been awesome. Thank you.
Well, you're more than welcome, and hope you'll join us for part 2 of this next time.
This was a fantastic flashback, Bruce.
You meant that in a positive way.
I took completely positive.
Yeah, well, I hope everybody got out of it, and you know, you can send it out to your folks, and you know, we're gonna have part 2 of this. I can't remember when that is, but it's coming down the pike.
Yep. Excellent.
It's October 19th, I believe. Thanks so much for doing this, Professor Behn. And I've put a message in chat, but we'll be sending the recording out to folks later on this afternoon.
Perfect.
Awesome. Thank you so much. Good seeing you guys.